Welcome to today's explainer. Look, our objective right out of the gate is crystal clear. We are going to objectively analyze Oscar Health as an investment. We're going to tear down its growth, its profitability, and exactly what is driving its stock through what has honestly been a highly volatile 5-year roller coaster. I'm incredibly excited to unpack this one with you today because it's this really unique blend of hard financial figures, complex market dynamics, and some serious tech-driven operating leverage that makes Oscars such a fascinating case study right now. Let's get into it. Okay, here's our roadmap for today. We'll start with the Oscar Health setup, move right into the growth and profitability metrics, weigh the bull case against the bear case, and then we'll wrap things up by looking at future catalysts and risks. Section 1. The Oscar Health setup, from startup to scaled ACA insurer. Now, if you followed Oscar's stock since its IPO, you know it has faced a wild 5-year journey. We're talking severe lows and a massive crash in its early public days, but the recent turnaround trajectory, it's pretty remarkable. When CEO Mark Bertolini took over the reins back in April of 2023, shares were trading at literally $2.51. But as the company clamped down with serious operational discipline and really leaned into their unique network economics, the value absolutely skyrocketed. Fast forward to February 2026, and they've reached 3.4 million enrolled members, catapulting them to a massive market valuation of roughly $9 billion. So how exactly did they pull off a turnaround of that magnitude? Well, it comes down to their DNA. Oscar differentiates itself as a true tech-first insurer. Instead of taking the traditional route and selling broad networks to large employers, they're intensely focused on the individual marketplace. They use what's called a narrow network model, essentially contracting with specific, localized provider groups. And for the individual consumer, this yields far better underlying economics than what the legacy giants are offering. Section 2. Growth and profitability metrics, analyzing the 2025 results and 2026 guidance. Let's dig into the hard data, starting with a massive top-line number. For the full year 2025, Oscar reported an incredible $11.7 billion in total revenue. That is a 28% jump year over year, and it was entirely driven by their ability to capture significant, above-market membership growth. And when you line up their 2025 actuals against their 2026 guidance, the projected turnaround becomes super clear. Look at this. While 2025 ended with an operating loss of $396 million, their guidance for 2026 anticipates a nearly $750 million year-over-year swing. They're guiding for $250 to $450 million in operating earnings. You'll also notice their SG&A expense ratio and their medical loss ratio, which is basically just the percentage of premiums actually spent on medical claims, are both projected to drop significantly as that top-line revenue scales toward $19 billion. But hey, it hasn't been a perfectly smooth ride. Looking closely at the past 2 quarters, we had a pretty massive speed bump. Q3 showed stabilization and steady footing, right? But then in Q4, their actual medical loss ratio suddenly spiked to 95.4%. That's up 730 basis points from the prior year. This was primarily driven by higher-than-expected claims and a huge $275 million risk adjustment accrual that just completely slammed their bottom line for the year. Section 3. The bull case, technology, operating leverage, and market share. For investors backing this stock, the whole thesis is anchored heavily by Oscar's unique blend of AI automation and striking operational efficiency. Just think about the dramatic operating leverage happening right now. Over the last 2 years, as their annualized revenue effectively doubled, jumping from roughly $8.9 billion to $18.6 billion, their overall headcount actually dropped by 95 people. Let that sink in. They pushed their revenue per employee from $3.7 million to an absolutely incredible $8.1 million. The bulls will be the first to tell you that this kind of efficiency is no accident. It is the direct result of their proprietary, cloud-based Oscar tech stack. They're heavily leveraging AI to automate 40% of their prior authorizations, and their Oswell AI agent is now successfully handling 86% of all member inquiries. Because they've created this relatively frictionless experience, they managed to expand their market share from 17% up to 30% across their footprint. Plus, they're rolling out highly targeted lifestyle plans, like Hello Meno for menopause care, which are driving massive retention and a 50% boost in direct referrals. On top of the tech, Oscar has proven to be incredibly agile. They aggressively expanded their broker channels, which, by the way, is where they get over 90% of their enrollments, and quickly adapted to consumer price sensitivity. They managed to successfully shift their member base heavily away from silver plans, dropping that segment from 71% down to 36%, weighting the book much more heavily toward bronze and gold plans. This is absolutely critical because it pushes members into cost-effective tiers with much higher margin potential and better risk pools right ahead of any possible market contractions. Investment analyst Robert Reynolds really hit the nail on the head here. The optimistic view is simple. Oscar is scaling rapidly through arguably the most notoriously difficult part of the insurance market, and they're pulling it off without bloating their administrative base. The bulls believe that if Oscar can prove this tech-heavy model works in the ACA market, there's absolutely no reason they can't eventually take on the much larger commercial markets. Section 4. The bear case, scale disadvantages, and regulatory headwinds. But of course, to fairly evaluate the stock, we've got to flip the coin. Health insurance is a brutally competitive industry, and structural threats loom very large for a company of Oscar's size. The central tension for the bears basically boils down to scale versus agility. Sure, Oscar is nimble and tech-forward, but they often struggle to negotiate favorable rates with entrenched hospital systems. When you're up against 800-pound gorillas like United Healthcare, who can leverage over $370 billion in revenue to dictate terms, Oscar's smaller footprint puts them at a severe unit cost disadvantage in certain key regional markets. And then there's the ACA's risk adjustment mechanism. This is where things get really tricky. Essentially, Oscar's profitability is held hostage by this rule. Because Oscar's sleek tech tends to attract slightly healthier digital native members, the system forces them to pay out massive sums to competitors who have sicker risk pools. This cost Oscar 18.5% of their direct premiums in 2025, and it is projected to rise to 20% in 2026. For investors, this makes forecasting earnings incredibly difficult and highly volatile. Section 5. Future catalysts and risks. Subsidies, inflation, and exit strategies. Let's pull back and look at the broader macro environment through 2026. According to the latest KFF report, the single largest looming risk for the entire sector is the expiration of enhanced premium tax credits at the end of 2025. If these subsidies expire, we could see average out-of-pocket premiums spike by more than 75%. If that happens, insurers fully expect healthier members to drop their coverage, which worsens the risk pool, exactly when medical costs, things like expensive GLP-1 weight loss drugs and labor inflation, are forcing baseline premiums up by a staggering 18%. Now, it's not all doom and gloom. On the positive side, Oscar is seeing massive growth in ICHRA plans. This is a huge catalyst where small employers basically shift their workers onto individual ACA plans, a segment Oscar actually doubled last year. Because of all this intense volatility, analysts suggest a very disciplined, momentum-based exit strategy for current investors, rather than just blindly relying on a rigid price target. The strategy here is to let the position run while the operating evidence remains intact. But if the stock breaks below its 63-day moving average, you reduce exposure and lock in those gains. And if you see a confirmed break below the 200-day moving average, you fully exit the position to protect your capital. So I leave you with this final, crucial thought to help you form your own investment thesis. Does Oscar Health truly have the technological momentum to redefine American health insurance and eventually take on those legacy giants? Or will the crushing scale of competitors and these massive regulatory shifts halt their progress right here? That's the puzzle you have to solve. Thank you so much for joining me for this explainer. Keep learning, and I'll catch you next time.